Iran says the Strait of Hormuz is closed, sending global oil and gas shipping rates through the roof. Iran says it will fire on any ship trying to pass through the Strait of Hormuz, where a fifth of global oil and gas travels. The US military's Central Command says the strait is not closed, but in practice, ship owners and insurers are clearly not willing to risk it. Global oil and gas shipping rates have soared. At the same time, a number of oil and gas facilities in the Middle East have shut down as a precautionary measure after they came under fire from Iran, including all of Qatar's LNG exports. Joachim Klement is head of strategy at Liberum Capital. Joachim, how serious is this then for the global supply of oil and gas?
In the short term, this is quite serious because, as you said, it is a substantial part of global oil and gas supply. And the really bad news is that Saudi's largest oil refinery has now shut down and Qatar can't export gas, LNG, anymore. So that will disrupt global supply at least for the next 4 weeks, potentially longer. And this is what oil and stock markets are pricing in now.
Is this just the beginning, though? I mean, should oil and gas markets be pricing in significantly more disruption than this?
I don't think so. I think we are now pricing in the appropriate level with the Strait of Hormuz basically closed or almost closed. When it comes to oil, some of it can be rerouted through pipelines to the south of Saudi Arabia and into the Red Sea. So there the shortfall will not be as large as it is today. So I think overall we are reaching sensible levels for the time being.
The spike in the price of LNG in particular, though, is a crucial component of inflation, especially in Europe and the UK. Should we then expect this could cause an inflation spike and potentially derail central banks' easing plans?
Yeah, at the moment, our models indicate that for the Eurozone, inflation will rise by about 0.3 to 0.4 percentage points. For the US, about the same. This is enough to stop rate cuts, but it is probably not enough yet to increase interest rates just yet. However, the longer supply disruptions last, the bigger the inflation impact from oil and gas prices will be. And if they last well into the summer, then we could see a situation where central banks must react.
Big shipping firms, including Maersk, have also said they won't risk sending container ships through the Gulf. So this will also have consequences for goods inflation, won't it?
Well, the shipping rates are such a small component of the final consumer price basket that it basically disappears next to the energy impact. That is a much more important one. And then the other thing is the second round effect, how energy inflation is priced into food prices from higher fertilizer prices and things like that, as we have seen in 2022, 2023, when the inflation spiked after the Russian invasion of Ukraine.
We're also seeing this in the bond markets, aren't we? The Treasury yields are higher, even though we would expect safe haven demand.
Yes, the Treasury markets is actually the main cause of concern for me at the moment as an equity investor, because Treasury markets are moving rapidly higher, pricing in both significantly higher inflation and higher real yields. And the real yield increase is what kills stock market valuations in the long run. I think there, when it comes to the Treasury market yield increase, we have overshot in the short term as people are pricing in too much of rate hikes in the Fed.
Why, though, are we not seeing that traditional safe haven trade that you might see in times of geopolitical turbulence where money goes into treasuries?
At the moment, you do see the safe haven trade when it comes to dollar demand, but it is sticky in the short interest rate and in the short term bill market, not so much in the bond market, where inflation fears and basically the gut reaction 3 years, 4 years after the Russian Ukraine war is playing out at the moment. I would say that we're not anywhere near that scenario of a Russian energy price spike that we've seen 4 years ago, but that is what the market is playing at the moment.
That was Joachim Klement of Liberum Capital. Don't forget you can watch more videos on Reuters.com.